Let's get started. Thanks everyone for joining us today. We've got a few people that joined us from the last webinar as well, which was our very successful Div 7A management webinar. Now we're moving into it's quite topical. It's into restructuring your business structures for growth, but for also many different reasons. We'll take you through a little bit what we're going to cover today. But yeah, thanks for joining us.
Fantastic. All righty. Just a brief introduction before we get stuck into the webinar content. Riz and I are representing Inspire Accountants, Fortitude Valley in Queensland-based accounting firm working with small business owners around Australia. One of the things we're known for is our ability to help save tax. And to date, or actually since I think we started counting in 2016, that number's just ticked over $28 million in tax savings and counting, which is pretty cool. We've also got an upcoming webinar. So I think a link will be posted in the chat box in a moment. But we'll have in about a month's time, we'll have a webinar all about estate planning and asset protection. So this is a deep dive into the methods behind, especially around the structures around estate planning. It's often a misconception that you just need a will, but when you're a business owner, there's a lot more things to consider, including how assets in trusts and companies are passed from one generation to the next per your wishes. So, quite a complex topic, and that will be presented by Riz and Sakshi from our team.
And it's particularly important as well if you're obviously running a family business, and there's plans to have your, intergenerational kind of people taking care of that business. Estate planning for your business, not only your personal wealth, is really important. And we covered that in that webinar as well. So there's a link in the chat if you do want to sign up for that. Really looking forward to that one.
Fantastic. Just a brief personal intro. My name is Ben Walker. I started Inspire when I was 23 years old, just over 10 years ago now. I'm an award-winning chartered accountant, 17 years accounting experience in total, and I'm the author of Wealth for Life, and even more recently, which we've got a slide for in a moment, a new book that's literally I just picked up 2 nights ago, or just got delivered two nights ago. Called It's All Sorted. All righty, Riz.
Awesome. And yeah, for those of you who don't know me, my name is Riz. I look after a bunch of clients and that I do love working for. And I started Inspire in 2016, and yeah, the rest is kind of history. A bit about me, just started pelotoning, and yeah, it's not really that new actually. I started that in April, and also not really a new, I guess, new dad. He's turning 1, little August in the picture in the bottom right. But yeah, if you have any parenting tips, feel free to drop that directly to me as well. But yeah, I'm really proud to say that we've worked really hard this year to save some of our clients some tax as well. And we're clocking, we clocked about 2.2 mil in tax save for the clients that we look after and counting. So yeah, that's a little bit about me, but yeah, what I'm passionate about is actually sharing some really cool ideas with business owners. And in this whole idea of, we don't know what we don't know. I like to try to make what you don't know is as little as possible. So if we can provide you some sort of value today, you walk away with some new ideas, or even it triggers some conversations or thoughts on how you're going to, change the way you run your business or even in your structures. That's awesome. And that's what we're here for.
Awesome. And also just I think another thing worth mentioning is, today's webinar will be the general principles behind restructuring. But if you'd like to talk one-on-one and start that process of potentially, getting our help with a restructure or just generally your business accounting, then you can do that by booking in for a strategy call with one of our accounting team. Again, thanks, Rons, for posting the link there in the chat box. But yeah, at any time you can feel free to book a call in, and one of our team will be able to have a chat about, I guess, what it looks like to get this advice or whatever you're looking for applied to your personal scenario. And just the mention of the book. It's All Sorted was released. I got the first batch of books delivered literally on Tuesday afternoon, and the book is called It's All Sorted, and the focus is a 9-step guide on how to master your tax and achieve peace of mind. It is for business owners, and it does include the basics around tax for business owners, but also things including some content around restructures and advanced concepts like Division 7A and how we manage those things. So if you do want a copy, again, the link will be in the chat box or the QR code here. Plus, this coupon code pre-order will just drop the price by the postage and handling. So it's a bit of a $10 discount. Cool. All righty. Now, Riz, what are we going to cover today?
Yeah, I guess, like I mentioned at the start, there's a multitude of reasons why you might want to consider restructuring your business. So we obviously want to start with that. It's like, why would you need to do that? And obviously, if you're here, something would have triggered you to sign up, and there's something happening in business, and hopefully it's on that list. But I'd be interested to know if there was not, when we go through, if it isn't on that list, just drop that down and we can chat through that as well. But we'll also cover a few other things. A restructure is a bit of an undertaking, but if done right, it can be done very smoothly, very structured, and done very quickly as well. So we need to understand what we need to consider throughout the process of restructuring, even before and even after as well. Now, in our time, we've also been able to do a few restructures of our clients, and applying some of those the kind of, call it, the theoretical knowledge that we know about restructures and the tax advice that goes with it as well. We've got some case studies that we want to share. They're pretty high level, quite simple to show you why and how those restructures can work. But most importantly is, what are some of the benefits of doing so? Like, it's going to cost you time, money, energy, and also a lot of advice as well to get it right. There must be a real good reason why you're doing it. So we'll take you through. We'll spend quite a lot of time in that benefits of restructure. There's a few dot points in there that we'll kind of dive deeply on, so that you understand where if you're sitting in one of the situations or in the case studies, you can understand why you should restructure, or what are some of the benefits that you can look forward to. But that's as a high level. If you have questions, we have the Q&A box. Now, if you use the chat, like I said, some of you have kind of weird names. Do put your name in there as well. As we'll take questions as we go along. We'll try to pause for some questions, and we have some time at the end as well for some Q&A.
Fantastic. All righty. All right, let's kick off with, just a few things to consider about why you would need or want to restructure. One of the most common things is actually that our client's initial business structure doesn't allow for the growth of the business. And we'll have a few case studies to go through why that might be, but that could be, actually the next point here is succession, which is one of them. It could be bringing in another investor, a third party, management, buying into the business, and the original structure doesn't necessarily allow, or it's not ideal in the circumstances for that stage of growth. But it could include things like wanting to add product lines or locations if you're a geographical based business, such as like a gym or a health clinic or whatever it is. And then there'll be reasons we'll get into of why you might want to consider restructuring through that process.
Yeah, and like I mentioned at the start, succession is an important thing, especially in a family business. I think there's some really cool family businesses in Australia, that's still owned privately, and the reason why they have multi-generational control is there's really clear succession plans as well. So some structures you just can't do it; it's just not as viable or as easy to keep the succession line. But also it's kind of like how it's written up as well. So it's important to understand that. So that's something that you want to consider, and it kind of leads to the next dot point as well, is some businesses don't really get to survive some of the difficult parts of business. So you want to make sure that you protect your businesses as well, especially if you have multiple businesses. So looking at your asset protection as a strategy, and then how we can mitigate any business risk as well that comes along with running your day-to-day operations, is a real good reason to consider restructuring business. Just particularly if you're kind of sitting in that sole trader kind of side of things, and a lot of risk is you're taking a lot of that risk. We want to be looking at restructuring that business. Few more dot points. I'll go through the next two, and
yep.
And in terms of the access to R&D tax offset, the R&D tax offset, it stands for Research and Development Tax Offset. So the ATO has a program where if your activities are in research and developing a new product and an innovative product, the ATO actually gives you a tax offset for those activities. It's actually quite a good, I call it a grant or subsidy. It allows you to build, more products or services. Now, and certain structures don't qualify for that. So if sometimes you want to restructure to be able to do that, like I said, the benefit has to be big enough. So it can't be just, we're just reading a little bit about a new product. It's actually developing and researching a new product and getting a big benefit of it to make sense. So the next one is exit strategy and plans. This is really future focus. If you're thinking of selling your business or in the future, floating it in the stock market or something like that, like you want to make sure that your structure can do that. And we'll take you through some case studies where, you can't do it in certain structure, and certain structures, it makes a lot more sense. And how early you do this as well matters, because you don't want to be having someone offer to buy your business, but you don't have your ducks in a row. So that's something that you want to be checking in as well, and something that you want to think really far out from that exit date, rather than kind of 6 months before.
Alrighty. The next one here is meeting industry requirements. So there's certain industries that require you to, let's say, have a company versus a trust. And if that's the case, ideally you get that right before you set up the business. Or if you're changing into that industry or some form of requirement where it needs a certain structure, that could be another reason why. And actually, we just talked about these quite at the start of this list, but yeah, adding product lines or adding locations, it may make sense to do that in a different structure to the one that you already have existing. All righty. This is definitely not an exhaustive list, but there's definitely some things of what do we need to consider. So there is tons when we're looking at restructuring. They're often very complex things to consider, especially around the tax implications. But yeah, I guess working through this list, we want to know what the current structure is versus the proposed structure and why we're sort of undertaking it. Now, once we know that, the commercial reasons why we want to do that, then we need to look at what are the tax implications from going from one to the other. Now, there actually could be multiple tax implications depending on how the restructure is done. For instance, rolling over from a trust or restructuring from a trust to a company, broadly speaking, there's actually three ways to do that from a restructuring perspective. And just touching on them quickly, we could sell the business and then rely on the small business CGT concessions. That could be one of them. There's also a small business restructure rollover that got introduced a few years ago. And there's also another, it sort of defers the capital gain where the trustee receives shares in that new company as its consideration, and we can ignore capital gains tax. Obviously all of those have their own requirements and pros and cons, but even just looking at from a simple trust to a company, we know that we have options, and so tax becomes complex, and we want to make sure that we're doing the option that makes sense for the client group. Similarly, stamp duty never ceases to be a nightmare, where it's a state-based tax. And I say nightmare because I'm in Queensland bias. We still charge stamp duty on business sales in certain conditions. And there are a handful of other states that still do that. Thankfully, New South Wales and Victoria have seen the light. And I can tell someone in the chat box is, and it's not public. It's just sent to us, but I know exactly who that is, even though they didn't prefix that with their name. Thanks for heckling, Steve. But yeah, stamp duty is one of those things to consider. Victoria and New South Wales have removed stamp duty on business transfers, which is great, but Queensland and a couple of others have not. So yeah, it's definitely a point of consideration. And then once we sort of have looked at that, then we sort of need to consider the steps involved as well. So, and this is sort of the practical advice where we've got things like eligibility for the CGT concessions or the rollovers. So I mentioned a few of those before. We also need a valuation in most cases. We need a valuation to support whatever we're doing from a restructuring perspective. And often there is legals as well. So lawyers' involvement for contracts of sale and making that all happen in a legit way.
And I might just dive one level deeper there from eligibility, evaluation, legal side. Like when we're talking about doing all this stuff, some of this stuff it's done before and the restructure happens, and usually that's the beginning. Now there's also the after, and that's the commercial challenges that we want to consider as well. Now, what we mean before is we want to make sure everything's measured, and we want to know what the tax outcome is, whether state-based or federal taxes. What is the cost of this transaction? Also, we need to understand again the benefits, right? Why are we doing this? Does it outweigh? Not all restructures make sense, although we might want to do it. There might be a timing thing as well, where we want to pick a later time or a different time to do your restructure, because we're not going through the CGT concessions and eligibility criteria all today, because they are quite complex, and there might be, that's its own webinar almost, but that's an important part of the transaction. Now, the valuation gives us the clarity on how much, and certain restructures don't need it, but if we do need it, it gives us clarity on what are we actually transferring across in terms of value, but it also kind of falls back onto the tax impact as well. Now, from a legal's perspective, it's not just about the transfer of your business or a sale of your business. You kind of really have to look at it from an arm's length dealing perspective. If you were to purchase a business, that's really what we're talking about here. If you were to restructure, it's kind of moving your business, all its contents, from one home to another home. So you're actually moving all of that across. So it's not just, usually people think, the physical stuff, right? Tables, chairs, and stuff like that. But we've got to think about like significant contracts as well. So we need to consider whether or not you have certain contracts that you've signed. For instance, a lease, how does that transfer across? If you have a supplier contract with a really good rate, and they've signed it to you personally, does the restructure allow them to renegotiate that rate? So this is the stuff that you want to make sure that it's not just an accountant involved. You have a really good legal backing as well, to give you advice around the significant contracts you have. And even we think about employees as well, right? How do we move that across? So it's important to understand it's not you want to kind of have this all measured out at the start before kind of going through it and kind of playing a bit of a guessing game. Now, in terms of commercial challenges after, like I say, it's a big undertaking. You're essentially moving houses for your business. You're changing the trading entity. So the entity previously ceased to trade is the new entity that starts to trade now. So we talk about the impact of the contracts and key suppliers as well. And there's an ABN change as well when that happens. So a lot of things need to be transferred to this new entity. So you need to kind of consider the time and effort that it takes to do that as well. Now, we talked about moving employees over to the new entity. It's like purchasing or selling a business. We need to be clear, are they re-employed, or do the entitlements flow over, like their leave and their annual leave, sick leave, and if there's any long service leave, does that flow over across? And yeah, we just want to make sure that all of that is ticked off as well. Now, from an accounting perspective, usually what we see is it's not a clear cutoff, like, it happens very, like a very clean cut. Typically what happens, even in arm's length business sales, what we see is over kind of a couple of months after the transaction has already happened, there's still some kind of teething issues or tying up that needs to happen. So, there'll be like money still being paid in the old bank account from your old customers. They didn't pay it to the new bank account. So what usually we do is we run two kind of accounting files just to make sure that the transition happens over the next kind of couple of months, so that we can close off the prior one as well. Timing is important. just not only from an eligibility perspective, but also effort as well. I wouldn't move houses if I'm expecting a baby in the next week. I wouldn't move your business if you're about to go for one of your biggest tenders. So it's kind of like picking your battles here a little bit. And if you're thinking of doing it, you want to think about it as early as possible and picking a good time as well. The other thing as well, from a tax perspective, we usually talk about kind of finishing up your prior business at the end of a tax period. Financially is great, but sometimes that's not perfect. At least at the end of a BAS period as well. Then you're not running two BASs at the same time. So little things like that just makes it a little bit easier. but also it's a makes it a clean cut. So financially is great, but again, depends on what you need and when you need it.
Yeah, and just before we get stuck into the case studies, what I might say is most of the restructures we do will actually see the trading entity change from one entity to the other. But there are some restructures, and what that could look like is actually like a company stays is the original structure, and it stays like that as the trading entity. It's just we're restructuring where the shares are held. That's an example where you don't actually get the challenges of changing ABNs and often like things like those key supplier contracts, if they're hard to get and hard to lock in, like big multinational corporates, they don't like necessarily just changing ABNs. It's not as simple for that for them, but it can reduce that trickiness. But again, it just depends on the restructure for all the commercial stuff. Howard's also brought up things like, employees changing over from one to the other and their service period for redundancy purposes, even things like long service leave. That's all got to be done within Fair Work guidelines. And my understanding there is that the new entity has to honour all the previous entitlements and as if they were working there for as long in the new entity as they were for the old one. So I think there's provisions for that to protect employees.
Yeah,
Well.
and the key thing is if it's internal, right, and it's between you, yourself, or you and your families, like you want it to be as less as least disruptive as possible to all your business operations. It should just happen in the background. It might be, from a customer's perspective, just a change of BSB account numbers for new income to come in. But whatever we can do in transferring that over, we do have a list of stuff that we go through. And if it makes it a lot easier, the simple steps that you can take, like just changing the name, cool. That's the option you want to go. So because there might be some way you have to reapply for a whole new tender, for instance. Then there's a bit of a headache. You want to know that upfront, way upfront, before you go through the process, so that you know what you're going into and if it's worth it or not.
Alrighty, so let's dive into our first case study. So what we've tried to do is keep these ideas as simple as possible. And often in these case studies, we're focusing on one or maybe two key elements of why this makes sense. This is a fairly common one, actually. So we're wanting to restructure to allow investment from another third party, whether it's management or a venture capital or whatever it is, or another business partner. We're looking to change the structure. And in this case study, we've got a discretionary trust. Now, a discretionary trust doesn't allow a fixed interest or a fixed percentage ownership in the trust itself. And they're very common where we see one family group running a business. So that's where like a very normal structure from that perspective. So when we want more than one family group owning that entity, we need to potentially change to one of two outcomes. One of them is a unit trust where we can actually have a fixed ownership percentage in a unit trust. And then the other one is a company where we can set the shares held in each family can own, or if there's multiple investors or whatever, companies can have fixed entitlements in shareholding. So that's I guess it's a very basic need or requirement of having that external investor, but again, a very common reason to want to restructure.
Yeah, and we see this happening from a sole trader to a company or a unit trust as well. And usually we see sole traders being born because it's the quickest, easiest, cheapest way to start a business. You just get an ABN in your name and then you kind of start trading. But I wouldn't trade for that for long. If it starts standing on its own two legs, the business, you do want to kind of separate it out, whether through a discretionary trust or even a company or unit trust. So because a multitude of benefits, and again, we'll cover the benefits in a second at the end, but you can already see where when we talk about growth, it's not just growth in revenue, but you need to also look at the risk, right? If the business is growing in risk as well, you want to be looking at that restructure. It's just basically corporatizing it, going into an entity that you can have a fixed investment, fixed percentage ownership. I recently did one for a client who was a physio, and he was trading through his own name, had leases, employees, all kind of, trading as Mr. So-and-so. And we had to restructure because he wanted to bring a business partner in. couldn't buy 10% of himself. So we had to put it in the company, and then essentially went through that whole, all the stuff that we need to consider, and then transfer that over to the company. And then that company essentially had a 10% ownership already set up for the new business partner. So yeah, pretty straightforward in a sense, but a lot of forethought that I just want to kind of put in place there.
All righty. Case study number 2. What have we got here? So yeah, this one's to allow R&D, so research and development, which we touched on earlier. So yeah, really, it's not every day we see this thing, but again, if we've got a client with a trust that is its trading entity, trusts aren't eligible for the R&D tax offset by themselves, at least. So what we need to do is either restructure the business that's doing the R&D into a company, therefore being eligible for it, or what we can do and have in some instances is set up a company in addition to the current trading trust, where the purpose of that company is to undertake research and development activity. So there's kind of a few options there, and that would obviously depend on the pros and cons of the impact of either of those on the client situation. So what would each outcome lead to? Having a look at where the client's at. So yeah, that's again a simple concept, but just another one we see from time to time.
And it's kind of like, the earlier that you know that you're going to do, I mean, it's hard, right? Structures do evolve because your business evolves. But if you do know you're going into an R&D venture already, you're going to be spending money to develop a product. Start with a company, at the beginning if you can. But obviously, if it changes, you can restructure. The other thing to consider as well is, if you're in Queensland and you're dealing with kind of building licenses like QBCC, they love companies. They don't really like trusts. It's funny because you have to lodge yearly reporting to them to make sure your balance sheet's strong enough, so that you don't go bust and not pay all your subcontractors. And when in our experience using a trust is you have to kind of, I'm not going to go into too much detail, but you kind of have to provide almost guarantees that this trust can run its own business. But whereas a company, it kind of stands on its own 2 feet. It has assets of its own. It belongs to the company. It's a bit more solid. QBCC is a bit more happy with that. So that's kind of industry specific. There's certain industries are like that. I know in the pharmacy industry, you have certain types of ownership restrictions as well. So you want to make sure that it's within your it fits your industry as well. If you have those challenges, obviously we can kind of seek external advice as well. Like QBCC is a whole different thing that you have to deal with. So yeah, there's reasons why you probably restructure to make it easier on you as well, because if you have to do that year on year, especially with QBCC, it's just a big headache that you don't need.
All righty. Next one here is restructuring to allow family succession. So what this looks like, or the scenario we see here, is that we've got parents looking to pass their business on to the next generation or their kids, and they might be in a trust or a company, and there could be things like they want to retain a certain percent or get paid out a certain amount or whatever it is. So they might have specific requirements of their restructure, but what we're looking to do is pass control or pass the business on into entities where the next generation have taken that control, or it's their own company or trust that they've set up, and will run the business from there. Just common things with this one is that the sale is likely going to be low CGT or no CGT, depending on the age and the valuation of the business, all that sort of stuff. But where we see this low or no CGT is around the small business CGT concessions, where we're able to look to reduce the gain that the parents make or the exiting generation is going to make, to reduce that capital gain down as far as we can.
Yeah. And I might add, like you see on the proposed structure, it's like it's the same company trust, company or
Mhm.
trust, company or trust. The key difference is that who controls that company or trust. Now, there's a multitude of ways to actually just change the control of an existing company and trust, like changing the director or changing the shareholder or changing the appointer or trustee of a trust. You can do that as well. Now, in this particular case study that we have, it was a client that had a business that was more than 15 years, and there was no CGT impact in selling that business. So you want to be looking at whether or not you can do that, because one of the things that you can do is reset the cost base of your business essentially. So if the parents were going to relieve this business in whatever shape, way, or form, either control or selling the business, I want you to take care of this business now. You can either take control of the company or trust that it's in, or you buy it. Now, if you buy it and you get some really get great tax outcomes like CGT concessions, 15-year exemption, you don't pay any tax on it. What that means is it just you sell that business with a new cost base, at a higher cost base, to this new entity. Now, what happens is the children, son or daughter, that looks after this new business now, when they go and sell it later down the track externally, they can actually use this new cost base and not pay too much CGT as well. The key difference is that the parents in this case study had owned the business for more than 15 years. So, and their age, they met the age requirement as well. Now, because they could do that, it just made sense to sell it. Now, if let's say that doesn't make sense, when you have a company or a trust, you can also change the control and have a succession plan that way as well. And that really leads to almost our next webinar around the estate planning side of things, is how do you actually pass control. But this scenario here is that also the parents are still alive and they want to pass it on. In the scenario with the estate planning involved is if they can't act or they are incapacitated, then someone else takes control. So you kind of have to also obviously look at the situation as well. In this case study, the parents actually just want to sail into the sunset with the money they've made so far, let the son take control. They're still alive, but they don't want to be part of the business anymore. So yeah, family succession, really, really cool, and very, very prevalent in Australia, especially a lot of family businesses.
Alrighty, here we go. Next one here, case study number 4, is restructuring to add a product or location. So, where we see this one is where the business owners want to introduce a new product or location, and it doesn't make sense, usually because of reducing risk, to set that up in the existing structure that they have. So it's very common for our clients in gyms where they've got more than one location to then go from their first location to then just setting up a new trust or a new company, having a second one to run that next location out of. Often when we're setting up multiple locations, the benefit of that is that if at some stage you bring in other owners, you may already have that separate structure already set up, ready to go, so that you don't need to restructure at that point to bring in another owner down the track as well. So, again, the clients where they're multi-location, we often see differences in their ownership, even though we've got a main client that we deal with. They might have location A with one other person, shared control, and then same with location B or C and so on. So yeah, it's good practice to have different locations in different entities, and similarly product lines. Now, that saying it like that, often I think of manufacturing if we're talking about products, but even services where there's different licensing requirements. So if we think of accounting and financial planning, for instance, they're in underneath financial services as a cap. But if I was going to add in financial services to what we do, I would definitely not do it under the accounting entity that we have. It would be set up in its own separate entity, if that makes sense, just to keep the risks of running either business as separate as I can, so that if one blows up for whatever reason, it's not going to take out the other.
That's right. And the thing to be careful as well is, like, once you restructure, you want to make sure that lending and borrowing money between those separate entities are well looked after, because it doesn't mean you just separate them and you kind of go, all right, cool, we're well protected. There's ways where you can still kind of connect the two entities by loaning money across each other or having money owed between those two entities. So and more often than not, that does happen, especially when you start new locations or new places. One entity has to fund the other. You just want to make sure that there's a plan of attack in terms of how to get that money back. Is it secured? Is it not secured? So it's not just the structure, it's how you use that structure going forward as well. I've seen also combinations here where, you know, you have a trust, but then you have the locations held by a company, or you have a company as a holding company with many different locations, for instance. It depends on your plan of attack as well. Why do you want those separate locations? I've heard of people going, I just want to piecemeal it later down the track, sell one location at a time. So I can do that very easily. And you also have to think from a performance perspective, valuation perspective. When you have separate entities like this, you have separate set of books. You can easily do a valuation for separate entities. You can also manage the performance of those different, call it locations, separately as well. Now, the other side of the coin, I've seen this done too early as well. And you want to make sure that you don't do it too early as well, where, you know, we've got really grand ideas, you know, I want to have an empire of many different locations, but all of them are quite small or just starting. And the issue with that is the cost of compliance that comes with many different companies, ASIC fees, accounting fees, lawyer fees, all this different, you're duplicating a lot of stuff, really. You want to make sure that it can stand on its own two legs first. And now that's why I see, that's why we talk about restructuring. You can actually sell a part of the business across, or start a new business separately, rather than kind of setting it all up and then, you know, having that cost running the whole time. And kind of the first few years is just you trying to make sure you're breaking even with those costs. So being mindful of that timing is also important on when you start doing this as well. The other thing to add as well is when we talk about product location, I've had people also separate out kind of their employees into one company or the other. You want to make sure that you're meeting all the regulations as well along with that, just because if you set up a company just to house your employees, that's where your employees are hired, they work for your main business. There's rules around it being a employment agency. So you're running an employment agency there. You have to kind of look at it that way, and you want to make sure that you meet all the rules and regulations around fair work and what's required there as well.
All right.
Yeah. So
Yeah.
keep moving, because we've got a bit on the benefit side to go through.
Yeah, we've got one more case study, and then wrapping up with a recap on lots of benefits we've talked about, and maybe some we haven't yet. But the last one, and you hinted on this just now, Riz, but restructuring to separate out business assets, or separate out other business risks. So we've got a current structure, whether it's just a single trading company or trust or whatever it is, but we want to split those out. So we've got a trading entity that's separate from the IP and assets, whether it's equipment, vehicles, or even things like IP, patents, those sort of things that you've built up in your business, but you want to separate them out so that if something happens to the trading entity, we've got some protection of those assets held separately. Someone said domain names there. Perfect. Keeping those ownerships separate. Now, this isn't necessarily a requirement to have it owned by a holding company. It's just an example of where we've got multiple business entities where we've also got a holding company that owns the whole lot, so that if you want investors at the whole business level, they can buy in here, or if you only want investors in at the trading company level, you could separate that out that way as well. And we've also seen people do separate entities for just the role of employing their team, to reduce the risk. I don't think it removes the risk, but reduce the risk of HR and employment law work affecting the trading entities and other business assets. Oh, there's the 5 case studies.
Those are the common ones that we see, and there's sometimes a mix of all of them, so it just depends on your business, right? So again, we probably won't have time to go through all the eventualities. If you do have a specific one you want to discuss, or you've seen one, you go, oh cool, like that's exactly my situation, I need to chat to this, guys. We'll drop the link again, book a call, and then we can have a chat about it. Okay.
Alrighty, and just regrouping on some of the benefits of restructures. So we've got brand consolidation, we've got streamlining processes within the business, if that's an idea of why we want to do this. A clean slate for the business to take into the future. So sometimes we want to, just move into a trading entity that hasn't had any drama in the past, or a more ideal one that we can get ready for eventual sale. Like there's clients who also want to do that as well. Clearer control, peace of mind. Adding possibilities to your structure. So yeah, again, that was one of the first ones we touched on, which was allowing for future investment, and then ability to align structures to fall under your estate planning wishes. So again, that's not usually a driver of why a client would want to restructure, but it definitely is something that we can incorporate into how we restructure, keeping in mind what their estate planning wishes are.
Yeah, and the other benefit as well, if done right and you're eligible for some rollovers or concessions, you can do it with not much cost in that transaction in terms of taxes. That's the same with stamp duty, depending on which state you're in as well. The benefit of doing that is you're essentially resetting the cost base of your business, right? So this is the one I was talking about before. Suddenly this cost base, this new cost base that whoever the new owner is, it gets to carry that forward. Now, if they sell that literally the next day, well, that's a bit dramatic, but I'm trying to show you an example here. But if you sell it the next day at the same amount, you don't pay any tax on that because that's the amount that you essentially purchased it for. The extreme example that I shared before was that there was no tax in that initial sale to the son. So when they sell it later down the track externally as well for the same amount, there wouldn't be any tax as well. So really big tax benefit. Now, this Division 78 management is also another thing that we've seen kind of creep up more often. Is it usually comes up when there's a trust that is involved. So Division 78, just a quick crash course, it's what happens when you owe a company money. And what happens is a business is run through a trust, and because a trust doesn't hold or retain any of its profits each year, it has to empty out. Some of that money ends up in a bucket company, for instance, for tax planning reasons or for investment purposes. The problem is that business itself, it requires quite a bit of working capital. So what it needs to do year on year is borrow that money back from the bucket company. Now, if we think about kind of that cycle, right, it's a pretty tiring cycle because you'll always have Division 7A to manage because your money's sitting in a bucket company that you have to borrow to run the business every time. And then you distribute it back again and borrow again. So usually that happens when the business is too big. At once upon a time, the trust runs on its own. You can do that. There's little amounts of working capital. That's fine. It got too big, too much headache with Div 70. That's where we look at corporatizing that as well. So usually that makes it a little bit clearer because now the business owners know, okay, how much do I leave in the company that is trading to retain as working capital or even for investments or to pay debts, whatever. And how much do I take out in the form of dividends? It doesn't automatically flow out like a trust. It's a choice each year that they can make as well. So yeah, that's more common. I see that a lot more as a common reason why someone would restructure. And then the next one is asset protection, right? So if you're like the sole trader situation I mentioned before, as the business gets riskier and riskier, more employees, multiple leases, you just don't want it to be all in your personal name. Because if you do buy a home and you have a personal home or PPR in your name, that comes at risk as well. It's all kind of in the same bucket there. Like I said, we talked about access to R&D grants and licenses before already, and the last dot point there is around debt recycling. It's the idea that you kind of shift loans between two entities to make sure that you get a very good tax deductible outcome when borrowing money. Now, this is around the borrowing money to purchase a business. Essentially, what it means is you in the transaction of purchasing that business or restructuring that business, you draw down on debt that becomes tax deductible. And usually that's a debt that you was previously non-tax deductible. It's a little bit complex, but there is a way to do that during the restructure as well. Because something you have to remember, right? Like, although it's a restructure between yourselves or your family, at the end of the day, it's still a sale of the business, if you're selling the business itself. So there needs to be some sort of funds accounted for when you purchase that business. So usually what happens is, because it's internal, you can set up things like vendor finance between yourself. And over time, as the new owner, this new structure makes profit, it can pay back to the original owners, which is your, whether your old family trust or yourselves. So that vendor finance sits there on that balance sheet that whole time. The other way you can do it is that debt recycling strategy, where you actually borrow money and actually pay that money out to the original owners, which is, again, you kind of have to think of it two different hats you're wearing: original and new owner for yourself. So it is there's a lot of benefits in doing it, but I just want to reiterate: timing. You got to make sure it's worthwhile. It's an undertaking, it's an effort, and get really, really good advice from accountants and lawyers to make sure you know what to expect, and you know that it's worth it as well. So yeah, we've got a couple of questions. They're all from Althea. So I don't know
Not
who
all
they
of
are.
them.
Some of them from Howard. Yep.
Yeah, so if you can just prefix your question with your name, that would be super handy. And yeah, actually, Riz, you just touched on something there at the end, which you said, good advice from lawyers and accountants. And funnily enough, some of the questions that have been asked, I would actually answer either with the assistance of lawyers, or even put it on them. For instance, the one that Howard's got around direct liability issues in the previous entity, stuff like that would absolutely need to be considered.
Sure.
It also, depending on your industry and what you're doing, you may even need to retain runoff cover for insurance purposes in the old entity. There's things like that would absolutely need to be considered. There's been a TAE, I'm not sure which one, not sure who it was, but you've asked, moving old assets from existing trading to a new assets holding, how do we value them? Well, they would need to be valued at market value. So if you've written those off to nil in the trading entity, and they're worth 10 grand or whatever they're worth, then there'd need to be a depreciation adjustment on the selling side, and you'd be able to claim depreciation on the buying side, or the new asset holding company. So yeah, not super straightforward. And also, when we're doing restructures, sometimes we also get a professional valuer in. So we had a restructure where there was a very significant amount of physical equipment, manufacturing, and we sent we got someone to go in who's whoops, sorry about the noise, whose job it was professional valuer to go and document all the assets that would move over. So that's another option if you've got a heap of stuff.
And I should mention, when we talk about business purchase and sales in restructures here, when we talk about the CGT concessions, the two items that don't get caught under that is any depreciable assets and also stock as well. So they treat it almost like a separate transaction whenever you restructure, depending on how you do it. Ben mentioned there was a rollover version as well, and all these other things. But where we look at the shifting of assets across, that's really around selling it really at market value. Because the ATO, from their perspective, they have this thing called a market substitution rule. You can sell it for $1, but the ATO literally says, look, if it's not arm's length, it's not at market value, we assess it at market value. So better do your own homework rather than the ATO doing it itself.
Cool. All righty. Another one on the asset holding company. Does there need to be a rent back agreement? That's an ideal outcome for sure. Just having some basis from a legal perspective in case things go bad in the trading entity, to have an agreement to say, no, this wasn't this wasn't sort of a back of the napkin deal. We've got an agreement in place that dictates the requirements of whatever that leasing agreement or rent back is.
I've seen case studies where you're trying to use your complex web of structures to protect yourself from something, and then one of the things they look at is it actually a legit structure, or is it done for a certain tax or certain purpose? And what they check is things like that, right? Is there rent back paid at market rate? Did you actually do that, or did you actually pay the money? So those are the things that stack up. If you have to remember, if you're doing this for asset protection, if it's going to get to that point, there will be, if you can't settle out of court, it will end up in a court, and they're going to ask the questions: was this done legitimately, or was it done for, call it a fictitious reason, right? So showing all that stuff stacks your case up a little bit better. Again, this is from reading the case law, because when you go through all the case law that's available from a tax in tax law, the courts look at it differently. They don't look at it from, like, what's on paper. They look at, like, okay, is it legit or not? So yeah, market rate stuff is important. We talk about rents, leases, or even license agreements. So that's where you're having a legal agreement to have that in place protects you even further, and carrying that out throughout the relationship. So, or the new structure operating as well.
Cool. Alrighty, and Jason's asked a question around merging with another business. It sounds like a bit of a complex question, but in general, I feel like there is a couple of ways that can be done. But I think it's important that that whatever that agreement is to pay a certain amount over the next few years or in the future, it needs to be done also with the lawyer and getting their assistance to help draft how that would play out from a legal perspective. And then if there is multiple options there, working out from a tax perspective what the best outcome there would be. But yeah, I'd say what you're looking to do would be achievable in some way, Jason.
That's an interesting one.
Yeah.
Very interesting.
Yeah, sure. I think, hang on, there's a Q&A panel. There are a couple of older questions. Who holds the personal assets operating company, discretionary trusts? Yeah, so I'm just not sure that there are a couple of older questions, but hopefully, James, we've answered those in the AI box.
Absolutely. Yeah, I think that's Jason again saying, good to hear that it's achievable, except their legal and tax compliance status. Yeah, and I think the outcome is achievable. It's how you're going to do that more than anything. Again, around those legal agreements, and yeah. I've had a situation kind of similar way, but it's within they're not merging, but from one family trust to a company, and they kind of want to identify what's happened in the past as well, so that it's fair going forward as well. But it was a little bit easier because it was internal. They kind of just reset and just kind of call it. At that point, everyone's already earned what they need to, and then going forward, this is the new rules of the game. A bit more interesting your situation, Jason, but definitely possible with the agreements in place. And lawyers can get really creative as well the way they do it. They have different names for different types of agreements. At the end of the day, it's understanding what outcome you're looking for and then putting in a pen to paper, really.
Awesome. All righty. So we might start wrapping up here, but yeah, I guess if you're not already following us, feel free to do that